Listen, you guys do fantastic work. I know you probably haven't slept in about 3 weeks. Are there any oil companies that you see that have just been dumped out with everything else that simply don't deserve to be?
Hey, Brian, as you know, we've been really pressing the haves in the energy industry. Those are names like Concho, Devon, Pioneer, Fang, Parsley. Those are the have-nots. Those are the guys that have, net debt to EBITDAs less than, 1.5 times. Don't really have any debt walls that are coming due over the next 2 years. Those are where we want to stay. Those things have been pounded. It's been very indiscriminate. That's where we want to concentrate our money.
Yeah, and it's all about net debt to EBITDA, right? I mean, if you're out there and you're thinking, wow, these companies have been whacked, I think 27 are down 50% or more this year, according to the last time I ran the data. Probably changed a little bit today. It's all about debt, right? You look for the ones that don't have as much as anyone else, and if you wanted to buy some, those are them.
Yeah, we're not really seeing anybody like gravitating down to those names at this point in time. As you know, the biggest issue for the market right now is what is demand going to look like this year and what's it going to look like next year. And with those debt walls out there, and especially in the next 30 to 45 days, you're going to see some of these banks are going to be redetermining their banking lending standards to these companies. 4 or 5 months ago, those the commodity price deck that they had there was high 40s, low 2s. Obviously, WTI is much lower now, and natural gas prices are much lower now. So those companies are going to continue to get the vice set to them.
Michael, I just have a question since you're in Houston. What happens to the Houston economy if oil stays at $45 a barrel or goes to the high 30s, as Jeff Curry of Goldman suggested last hour it could?
Well, we're not seeing that much of an impact, but, the one thing that we're hearing, and obviously Brian brought up a little while ago, is the Sarah conference was canceled. I know with our firm and other people that we talk to, investors that we talk to, behavior is going to be changing here over the next couple months. And so we expect demand's going to be down. That's not going to be good for pricing. That's probably not going to be good for Houston real estate, but we're just not feeling it at this point yet. But there definitely is going to be a change in consumer habits over the next couple months, and that's just going to be a net negative.
Sure, and I'm not surprised because in a way this move in the oil market has happened so quickly. I mean, it's basically just been a month or two of this plunge, and so I'm just curious, based on kind of the recent past, what happens when we get down to this level? Because for the U.S. overall, low gas prices don't help as much as they did for the consumer, and the low energy prices do hurt one of the stronger parts of the economy where you are.
Yeah, well, you're looking at it right now. There's going to be a big benefit for consumers with the lower natural gas prices and lower crude prices. As it relates to the companies, there's going to be a lot of companies that are going to be laying people off. Right now, Tudor Pickering, we expect that there's going to be CapEx cuts this year of 15%. Given where prices are now, it's going to probably be closer to 25 or 30%. That means you're probably not going to be growing U.S. production next year. There's probably going to be additional headcount reductions coming, and so that's not good. No, we're just not feeling it yet because it come down so fast.
Well, we did, I guess, if you want to find a long-term positive in some ways, and I mean positive for prices, not positive for the people that work in the industry, which is that production probably is going to go down. We are going to see the amount of growth slow down, if not contract, in the United States. OPEC, maybe this week, could take 600,000 plus more barrels off the market. If you had to look out, Mike, 2 years, a year, 3 years, do you think that there is a case to be made for oil prices?
I think there's a case to be made for higher oil prices in 21 and 22, and the reason why that is the biggest impediment to higher oil prices over the last couple of years has been U.S. production growth. At the current oil price, most companies cannot make money. You're going to see CapEx cuts happening. They're going to be fairly aggressive from here. And so I think most people are expecting we're going to have pretty good growth in 21. I just don't see that happening. So we're going to probably be looking at flattish growth or probably even negative growth. If we have demand start to snap back to the 1.2, 1.3 normalized type growth, there's going to be some room for OPEC to take market share. That will be a lift for prices. We don't expect prices to go to 75 or 80 bucks or anything like that, but I think from where we are right now, 60 to 65, I don't think is out of the question in 2021.